Can you believe the year is winding down already? If you're looking for some last-minute ways to reduce your taxes this year, then keep watching. In this video, I'll cover 3 things you can do before the year ends to reduce your taxes. If you stay until the end, I'll share one strategy that you can do even after the end of the calendar year. Hi, I'm Noel Lorenzana, your friendly neighborhood accountant. Welcome back. As the year comes to an end, you may feel it's too late to save money on taxes. However, depending on when you're watching this video, you can still make some last-minute moves to reduce your income taxes in the current tax year. Number 1, maximize retirement contributions. One of the best things you can do to reduce your taxes is to contribute to a tax-advantaged retirement plan. To reduce your tax bill, make sure you've contributed as much as you can up to the allowable limits. By doing so, it effectively reduces your taxable income. The annual limit for 401k plans is $19,500 in 2021, and you can make up to an additional $6,500 in additional catch-up contributions if you'll be 50 years of age or older by the last day of the year. For tax year 2022, the annual limit increases to $20,500. If your employer offers any type of contribution matching, it's a no-brainer to contribute at least up to the matching limit. As an example, if you contribute, say, $10,000 to your 401k plan, and let's assume you're in the 24% tax bracket, you would save $2,400 in taxes. Number 2, take capital losses. If you own stock investments, this is the time to evaluate your gains and losses. Selling losing stocks can provide a capital loss that can be used to offset other types of income. If you have big winners, by hanging on to them, i.e. not selling, you will prevent triggering the capital gains tax. One strategy is donating appreciated stock directly to a charity. It's one of the most tax-smart ways to give. It works like this. If you've held your stock investment for over a year, you can then donate it to your favorite charity and claim a charitable tax deduction for the full market value of the stock. This also prevents you from recognizing the capital gain and the corresponding tax bill that would have gone with it. If you're thinking of donating loser stocks, don't do that. Instead, sell the stock, take the capital loss, which you can claim on your tax return, then donate the proceeds. Number 3, bunch deductions. Timing your deductions can make a huge difference in your taxable income. With the recent increase in the standard deduction, many people no longer itemize their deductions. However, if you time it right, you can have the best of both worlds. For example, let's say you're married and filing jointly, which gives you a standard deduction of about $25,000. If you have deductible expenses of around $20,000 each year, you would be best off using the standard deduction, which would give you a $50,000 deduction over a 2-year period. However, what if you could move some of next year's expenses ahead to this year? If you made additional donations or tax-deductible expenditures early, you could move that deduction to the current year instead of, say, next year. Let's say you did this with $10,000 worth of expenses. This would leave you with an itemized deduction of $30,000 in the current year, increasing your deduction by $5,000. The decrease in next year's expenses wouldn't affect you since you'll be able to take the standard deduction for the next year anyway. A simple shift of bunching your deductions in 1 year can make a big difference. A quick note about charitable contributions. The law now permits taxpayers to claim a limited deduction on their 2021 federal income tax returns for cash contributions to charitable organizations even if they don't itemize their deductions. Taxpayers, including married individuals filing separate returns, can claim a deduction of up to $300 for cash contributions to qualifying charities during 2021. The maximum deduction is $600 for married individuals filing joint returns. Lastly, the bonus strategy, the traditional IRA. The IRA, or traditional individual retirement account, is another great tax saving strategy. If you qualify for one, you can make a tax-deductible contribution which effectively lowers your taxable income. The 2021 and 2022 limit is $6,000, $7,000 if you're over age 50. These are subject to income limits and not everyone is eligible, so be sure to consult with a tax advisor to go over your specific situation. The deadline for contributing to a traditional IRA is April 15th of the following year, so you have extra time with this one. If you found the video helpful, please support the channel by hitting the like button and consider subscribing so you don't miss any updates. Thanks for watching and see you in the next video.